Would you take a mortgage you'll never pay off until you're 80 or 90 years old? Because that's exactly what a 50-year mortgage does. On paper, it looks like a dream. Super low monthly payments, easier approval. When you run the numbers, you realize it might be the closest thing to renting from the bank for half a century. Today, I'm breaking down the pros and the cons and the real math behind a 50-year mortgage, so you know whether it's a smart tool or a financial trap. Hey everyone, I'm Jamie Herring from the Herring Homes team with Coldwell Banker Realty. And today we're diving into one of the most controversial mortgage ideas being discussed everywhere in 2025, the 50-year mortgage. Let's talk about how it works, who it helps, and who it hurts. So let's start off. What is a 50-year mortgage? A 50-year mortgage is exactly what it sounds like. 600 monthly payments stretched over half a century. Why are people talking about this? Because with rising home prices and higher interest rates, many first-time buyers are getting priced out. Lenders are looking for creative solutions to make home ownership affordable, and extending the loan term is one of them. So let's look at pro number one. It'll give you lower monthly payments. Let's compare on a $400,000 home at 6.5% interest rate. A 30-year mortgage payment is around $2,528 a month. A 50-year mortgage payment is around $2,150 a month. That's roughly a $375 per month savings. For many households, that difference can make or break approval. Pro number two, it's a lower entry point for first-time buyers. 30 years ago, the average American home cost around $120,000. Today, it's over $420,000, a 250% increase, while wages only grew around 80% during that same time period. A 50-year term can help people get into the market sooner instead of thinking they have to rent forever. You've heard me say this before. Pro number three, home ownership builds generational wealth. Study after study shows that homeowners have significantly higher net worth than renters. In fact, according to the Federal Reserve, the median homeowner has 40 times more wealth than the median renter. So even if the mortgage is long, owning real estate is still one of the most powerful tools for building generational wealth. But now the cons. This is where the conversation gets real, because the math on a 50-year mortgage, it can be brutal. So con number one, it's basically renting from the bank forever. In the early years of any mortgage, 30, 40, or 50 years, almost your entire payment goes to interest. But with a 50-year mortgage, it takes more than 50 to 20 years before you start meaningfully paying down principal, meaning the bank owns most of the equity, not you. You're making payments, but you're not truly building ownership. Con number two, interest costs are enormous. Here's the math. On a $400,000 mortgage at 6.5% over 30 years, your total interest is $352,000. Over 50 years, your total interest is $660,000. That's an additional $300,000 you're going to pay in interest on this home. So you get a smaller payment, but you know who makes more money? The bank makes $300,000 more off of you. And the final con, you must stay longer to build equity, which is hard when the average age of the first-time homebuyer is 40 years old. So with a 50-year mortgage, if you sell in the first 5 to 10 years, you've barely touched the principal. That means you have little equity gain, you have less profit when selling, and you're at risk if home prices drop. A long-term mortgage like 50 years only works if you're willing and planning to stay put. So what's the middle ground? This is where smart buyers can win. Take the 50-year mortgage for the lower payment, but you have to schedule payments like a 30-year or maybe 40-year mortgage. That means every extra payment you add goes directly to the principal. Even an extra $100 to $200 a month can shave years off the mortgage and save you thousands and thousands of dollars in interest. The key rules? Buy a home that you plan to stay in for at least 7 to 10 years. I tell my clients to buy their next home, not their now home. Number two, make extra principal payments consistently. And 3, don't rely on the minimum payment. Use it as a cushion and not a crutch. So in conclusion, is a 50-year mortgage good or bad? I'm kind of in the mostly bad category, but the answer is depends how you use it. If you treat it like a traditional mortgage, it will delay equity, it will cost a fortune, literally a fortune, and it will make you feel like you're renting from the bank with no end in sight. But if you treat it like a tool, you will get lower payments, a little more flexibility, and a pathway into home ownership that might otherwise be out of reach, as long as you pay it down faster. Real estate is still one of the best ways to build wealth for your family. The trick is understanding the math and staying in control of the loan instead of letting the loan control you. If you found this breakdown helpful, hit like, subscribe, and drop a comment below. Would you take a 50-year mortgage? Why or why not? And if you're in the Chicagoland area or southern Wisconsin and you want to talk about home buying strategy, reach out anytime. I'm Jamie Herring from the Herring Homes team with Coldwell Banker Realty, and I'm here to help you make smarter moves in real estate.